All right, let's jump straight into our analysis of the June 16th, 2026 market tape. This was a day where unprecedented geopolitical relief collided with a massive AI compute shift, and it sparked a mega cap disruption unlike anything we've seen in recent memory. If you really want to understand where the market is heading next, well, this single day of trading is basically your ultimate decoder ring. To really wrap your head around the sheer scale of the disruption we're breaking down today, I want you to keep this number in your mind. $433 billion. That is the market cap gained by a single company in just one trading session. To put that into perspective, that is the entire size of MasterCard. Just poof, created out of thin air between the opening and closing bells. We're going to break down exactly how and why that happened. So, here is our agenda for the explainer. We'll start with the global macro catalyst, observe the divergent market reaction, analyze the orbital AI shift, check the consumer and corporate pulse, and finally outline the new market playbook. Starting with Section 1, the global macro catalyst. Let's look at what shifted the market floor. So, over the weekend, the Iran peace deal is announced, and bam, it immediately triggers this massive risk-on environment. The immediate reactions were huge. Brent crude futures shed nearly 5%, dropping down to $83.17. The 10-year Treasury yield fell 0.80 basis points to 4.45. And, crucially for equities, the odds of an impending rate hike just plummeted from 70% down to 55%. The inflation fear premium was quite literally sucked right out of the room. But here's what's fascinating. 2026 completely broke the historical playbook. If you look back at past geopolitical oil shocks, the 1973 embargo or the 1990 Gulf War, we usually see these massive triple-digit oil price spikes, extreme dollar vulnerability, and investors just rushing into safe havens like gold. But look at 2026. Peak oil only spiked about 21% back in February. Why? Well, unlike the 70s and 90s, the pre-war state was an oil glut, mostly driven by Chinese stockpiling. Plus, U.S. energy independence heavily buffered the dollar, so those traditional haven assets actually collapsed. Gold fell 20%, and silver dropped 25%. The old rules? Yeah, they just didn't apply here. Moving on to Section 2, a divergent market reaction. Let's examine this fragmented shift. This timeline gives us the anatomy of a really divergent risk-on rally. From June 2nd to the 15th, the market was actively front-running the catalyst. 7 of the 11 S&P sectors rallied, while tech actually fell 8%. But then the peace deal drops over the weekend. Come Monday, June 16th, we get the massive reversal. Capital aggressively flees those value and cyclical stocks and rushes right back into tech. It was just a textbook, ruthless execution of buy the rumor, sell the news. The contrast here is just stark. Technology shot up 3.4%, while energy bled out, dropping 3.6%. Big tech software, semiconductors, AI names, they became a giant vacuum, absorbing all that newly freed liquidity. Meanwhile, energy stalwarts like Occidental, Halliburton, and Chevron were left completely lagging behind. The market wasn't just buying everything, it was highly, highly selective. Section 3, the orbital AI shift. Let's talk about that massive tech influx. Look at this valuation disconnect. It is absolutely wild. On one hand, you have Amazon, the established, fundamental giant with a $2.65 trillion market cap, generated on a massive $717 billion of 2025 revenue. On the other hand, SpaceX, the narrative premium. SpaceX rocketed to a $2.54 trillion valuation on just $18.7 billion in revenue. In one single day, SpaceX expanded by the entire size of MasterCard to essentially match Amazon's cap. What fueled this? A perfect storm of imminent NASDAQ 100 passive buying, an $11 billion IPO upsize, and Elon Musk projecting a $1 trillion revenue run rate. And institutional capital, they actively validated this disconnect. ARK Invest aggressively trimmed their existing holdings, even selling off Tesla, to fund massive SpaceX purchases. They aren't treating these companies as industrial manufacturers anymore. They're viewing them as high-margin mega platforms that are perfectly positioned to turn AI and critical infrastructure into unprecedented profits. So why does that premium exist? Well, the AI trade has fundamentally rotated. Phase 1 was the bottleneck trade, focusing on component manufacturing and hardware constraints. That trade is winding down now. The market is pretty much fully priced in those constraints. We are now charging full speed into Phase 2, end-state compute. The focus has completely shifted to energizing GPUs and sourcing sheer power.
SpaceX capitalized on this by leveraging orbital AI data centers, aiming for an astonishing 1 gigawatt per year of terrestrial compute by late 2027, backed by aggressive orders of NVIDIA's new Rubin chips. That is exactly what the market is buying right now.
Section 4. The Consumer and Corporate Pulse. Let's bring this back down to the ground-level reality. What we're seeing is that consumer sentiment has radically diverged into 3 distinct dials. Dial 1 shows high-end contraction. Luxury handbag sales, for example, are slowing down as status symbols evolve. Dial 3 shows intense corporate friction, which is highlighted perfectly by Marriott hotel owners rebelling against their corporate parent over a massive credit card fee pool. But Dial 2, that's the sweet spot right now, a surging mid-tier expansion. We saw a massive 5.1% jump in Bank of America card spending focused on travel, dining, and retail. The middle class is out there spending the relief. Meanwhile, the corporate M&A landscape is showing immediate friction. Look at these market reactions. Fox bids $25 billion for Roku to scale its streaming business, and Wall Street immediately punishes them. Shares plunge almost 17%, making it the worst S&P 500 performer that day. Truist names an outsider as CEO, signaling some major cultural upheaval, and their shares tumble 7%. What does this tell investors? It means takeover premiums are effectively erased right now. The market has absolutely zero patience for messy integrations or costly bidding wars.
To truly ground these high-flying tech narratives and corporate struggles in everyday trading psychology, we have to ask a seemingly counterintuitive question. Why on earth did Madison Square Garden sports stock drop after the New York Knicks won the NBA Finals?
It's the ultimate micro case for selling the news. So MSG Sports secures their first title since 1973 with a swift 4-1 series win. You'd think the stock would soar, right? Nope. It actually fell 1.2%. The mechanics here perfectly mirror what we saw in the broader oil market. First, you get massive profit-taking. The stock was already up 103% over the prior year. That championship run was fully priced in. Second, by closing the series in 5 games, the arena suddenly lost out on the highly lucrative ticket and concession revenue they would have gotten from a Game 6. It's a perfect reminder that markets are forward-looking pricing mechanisms, completely devoid of sentimentality. Section 5. The New Market Playbook. Let's map out the road ahead. Our forward outlook, the Catalyst radar, is absolutely packed. On Wednesday, June 17th, we have a monetary and macro check, as Kevin Warsh chairs his first Federal Reserve meeting. Thursday, June 18th, brings the literal Wall Street parade as the Knicks march right through the financial district. And Friday, June 19th, provides the ultimate geopolitical seal with the formal signing of the U.S.-Iran peace deal in Geneva, which is expected to reopen the Strait of Hormuz and really test global shipping. Based on all of this data, strategists are aggressively targeting the S&P 500 at 8,000 to 8,250. This target is built squarely on the new market playbook we've just decoded. First, you have the macro floor. Geopolitical shocks are settling, which caps those long-term yield spikes. Second, you have the compute premium. Capital is permanently migrating away from hardware components and into entities that can generate sheer power and terrestrial or orbital compute capability. But here is the critical catch, and what you really need to take away from this explainer today. With mega caps like SpaceX now trading on literally decades of future growth, these upcoming summer earnings reports are going to be the ultimate reality check. Wall Street has priced in absolute perfection. The margin for error is 0. So knowing what you know now about this massive structural shift, are you positioned correctly for a market that will punish even the slightest misstep? Give that some thought as you review your allocations this week. Thanks for joining me on this explainer, and I'll see you on the next deep dive.